Stephen, I think what's interesting is people have said, look, it's only 3% of imports anyways, but 3% is, well, that's still money, right? Going to Russia. On the margin, what does 3% or whatever the general range is of U.S. imports from Russian oil, what does that do on the margin if indeed that is cut out?
Yeah, absolutely. We're talking about still with 3%, but it's still a significant amount of oil that is coming in. More importantly, Russian petroleum products, so crude oil and petroleum products, imports last year jumped 24% of Russian oil and gasoline and so forth coming to the United States to a record 245 million barrels. So last year, the United States imported 250 million barrels of Russian crude oil and petroleum products. Now, of course, with that pricing and with that money going into the Russian war chest, we have the situation that we have now. What does this mean for the consumer? Obviously, it means extremely higher prices from here. With the way Brent crude oil is trading at this point, right around $118 a barrel, by the end of next week, there's a statistical probability we could be as high as $160 a barrel if the situation in Ukraine gets any worse.
Stephen, from a market perspective, do you think that there's anything that the Biden administration or the government in general can do at this stage that would, I guess, temper some of the pain that Americans would feel from a move like this?
The biggest move would be to change the rhetoric with regard to domestic oil and gas production. In the President's State of the Union address, he talked a lot about renewables, and that's certainly not going to answer the question, especially in the short term. In that 1 hour-long speech, 7,000 words, he did not mention domestic oil and gas production once. And still, in follow-up questions over the days past, they're still not addressing this issue. So throwing out an olive branch to domestic production and trying to get domestic production from where it is now, 11.5 million barrels a day of crude oil, to where it was pre-COVID, 13.1 million barrels a day. That is the quickest short-term response that the government can do. It's the only response the government could do that would have an impact.
Okay, interesting. What about the refining of that and some of the infrastructure that goes around it? How realistic is it that we can start making that an efficient use of oil?
Well, it certainly was prior, up through 2019, when we were rising, and we had a meteoric rise in crude oil production beginning in 2019 and through 2020, and through the start of the COVID mitigation protocols. So the capacity certainly is there. The concern now, of course, is that perhaps pent-up demand will even exceed what's been demonstrated capacity to the market. That is to say, the COVID mandates have essentially gone away, so you're going to see a tremendous amount of demand. Once the weather warms, the travel season begins, demand for gasoline begins. We already have gasoline that's trading, retail gasoline that's upwards of $3.73. If prices remain, crude oil prices remain this high, national average is going to be pushing up $4 going into the summer, then add another 30 cents to that, because in the summer, the market has to be supplied with summer-grade gasoline, which is a blended gasoline, which is more expensive. Yeah. So more expensive gasoline, greater demand. We're looking at higher prices, not lower prices in the months ahead.
Is the capacity there, though? I mean, I was looking at some of the capacity data we have on the Bloomberg terminal earlier this week, and it looked like generally we're running kind of in the high 70s in terms of our current capacity utilization here. If that is where we stand at the moment here, where does, I guess, an extra 20% capacity get us with regards to keeping prices in check?
Yeah, so with capacity now, we're in what's called the turnaround season. So this is the maintenance season. So this is the time that the refiners ramp down production. They go ahead, they refuel, they retool, and so forth. But in the months ahead, that capacity utilization rate will go up, and we've seen it as high as 95%. So right now, we are at a seasonal lull, and you go into a seasonal lull as far as manufacturing oil because demand is at a seasonal low. But as we both go ahead, once we get in and the refiners have to start buying more crude oil to run to ramp up that capacity into the 90% range, that's a lot more demand that's going to be coming to the market as we approach the 4th of July holiday.
Are the Strategic Petroleum Reserve releases doing anything on the margin?
No, the Strategic Petroleum Reserve never did anything, and because it was never designed to do anything. This was a pure gimmick. The SPR was not designed to manipulate gasoline prices. It was created after the 1974 Arab oil embargo, and all it is meant to do is to supply the market when there was a temporary disruption to the flow of oil. So when we had the release in November, it had no impact. In fact, crude oil prices have nearly doubled since November, and the latest SPR release will do absolutely nothing. We're talking a day and a half's worth of U.S. crude oil demand. It is just a meaningless prospect that where we're selling oil into the market. Hey, we're getting a great price for it, but that oil is going to have to be replaced at some point. So no, it has had anything. It's had a detrimental effect on pricing action.